Welcome to the deep dive. Today, we're really getting into the weeds with Grainger. We've got their Q3 2025 earnings call summary and the 10Q filing right here.
Yep, and our job really is to unpack what's going on, beyond just the surface numbers. Look at the strategy, the headwinds, especially tariffs, and this LIFO accounting effect everyone's talking about.
Right. And if you had to boil Q3 down, the company itself used this phrase: continued solid performance amidst muted market demand. So let's start with the big numbers. Total reported sales.
Up 6.1%. Came in at $4.657 billion. Pretty solid, like you said, given they feel the market's a bit soft.
And how did that flow down to the bottom line?
Adjusted diluted EPS. That was $10.21, which is up 3.4% from last year. So profit's growing, but maybe not as fast as sales.
So the money's coming in, but there's a tension there, isn't there? Daily sales, constant currency, up 5.4%. But you mentioned something about efficiency eroding.
Exactly. That's the key conflict here. While sales were up, the profitability metric slipped a bit.
Okay, walk us through that. What happened with margins?
Well, the gross profit margin, it dipped 60 basis points. That's 0.6% down to 38.6%.
Okay.
And the operating margin also fell 40 basis points, landing at 15.2%.
Right.
So they kept less of each sales dollar as profit compared to last year.
Right. So the big question is why? Selling more, keeping less. What were the main drags?
It was really two things hitting them. First, and this was the big one, cost pressures in their main North American business, the High-Touch Solutions segment. Specifically, this LIFO inventory thing tied to tariffs.
LIFO again. We'll need to circle back on that. What was the second factor?
The second was what they call a segment mix drag.
Segment mix drag. Okay, that sounds like corporate speak. Break that down for us. What does it mean in plain English?
It just means their faster-growing segment, which is the Endless Assortment business, naturally operates with lower gross margins than their traditional high-touch business.
Okay.
So as that lower margin business grows faster and becomes a bigger piece of the pie, it mathematically pulls the company's overall average margin down.
So it's actually a side effect of success in their growth strategy.
In a way, yes. But it's important to note they did point out that if you actually ignore that LIFO accounting impact, look at the underlying FIFO profitability. Their gross profit percentage did improve year over year.
That's a crucial distinction. So the underlying business efficiency isn't necessarily getting worse. It's these external pressures and accounting methods muddying the waters.
Precisely. And they're managing cash flow really well despite this. Generated, what, $597 million in operating cash?
Yeah, almost $600 million. And returned a good chunk to shareholders, $399 million through dividends and buyback.
It shows confidence. And another sign of focus, they announced they're planning to sell off their UK business, Cromwell.
Right, divesting Cromwell. Seems like they're doubling down on their core North American and online strategies.
Makes sense, streamlining the portfolio.
Okay, let's dig into those segments then. Start with the big one. High-Touch Solutions North America, HTS N.A. This is their traditional MRO supply business, right?
That's the core, yeah. Sales there grew 3.4% on that daily constant currency basis. And interestingly, most of that came from volume, 2.3 percentage points.
So people are buying more stuff, even if the overall market feels muted? What about pricing?
Price contribution is improving. They noted that they're starting to pass through some of those tariff costs.
Yeah.
But it's a process.
And within that U.S. high-touch business, are all customers behaving the same way?
No, definitely not. There's a clear split. Their documentation shows large customers grew sales at 7% daily.
7%, okay.
But mid-sized customers only grew at 3% daily.
Wow, that's a big difference. So the big guys are still investing and spending, while the medium-sized businesses are maybe feeling the pinch a bit more.
Seems that way. And you see similar divergence when you look at the end markets they serve.
Yeah. What stood out there?
Well, the strongest was contractors up low double digits. Think construction infrastructure projects.
Yeah.
That seems really robust.
Okay, construction booming. What about the other end of the spectrum?
Warehousing. That was down mid-teens.
Mid-teens down? That's a sharp drop. So construction's hot, but anything tied to warehousing, logistics, maybe e-commerce fulfillment that's cooling off fast tells you a lot about where the economy is right now.
Absolutely. It's a very mixed picture. And even with those decent sales in high touch, this is where the margin pain was most obvious. GP margin down 50 basis points to 41.1%.
And the reason was?
Same story, really. The documents are clear.
Yeah.
Continued tariff-related inflation causing unfavorable price-cost timing and LIFO inventory valuation headwind.
So costs are rising faster than they can adjust prices, especially on contracts, and that LIFO thing is hitting them hard here.
Exactly. It's a timing squeeze.
Okay, let's pivot then. Let's talk about the growth engine. Endless Assortment, or EA, that's Zorro and Monotaro, the online players. How did they do?
Oh, this is a completely different story.
Yep.
Sales growth here was 18.2% reported, or 14.6% daily, constant currency. Really strong.
Almost 15% organic growth. That's huge. Where is that coming from primarily?
Mostly Zorro in the U.S. That grew 17.8% daily. Monotaro in Japan was also very solid at 12.6% local currency growth. So both parts are firing.
Now, here's the interesting part. If High-Touch is getting squeezed on margins by tariffs, how is Endless Assortment, which is also selling products, managing to expand margins? That seems counterintuitive.
It does, but that's what happened. EA's gross profit margin actually went up 60 basis points to 30.1%.
Increased. Wow.
And the operating margin jumped even more, up 100 basis points, a full percentage point to 9.8%.
Okay, how? What's their secret sauce there?
The explanation given is twofold. Strategic pricing actions at Zorro. So they were proactive with pricing and a favorable mix at Monotaro. Plus, as they scale up that online platform, they get operating leverage. More sales dollars fall to the bottom line without proportional cost increases.
So they have more pricing flexibility online, maybe, and the scale helps cover fixed costs. Makes sense.
I also saw something with SKUs at Zorro. They have millions, right? Like 6 million active products.
Yeah, 6.139 million active SKUs listed for Zorro US. But they're actually reducing SKUs. For an endless assortment business, that sounds odd. Why cut products?
It's about optimization. Think quality over sheer quantity. They're likely removing products that don't sell well, have poor margins, or maybe clutter up search results.
Ah, curating the endless shelf.
Exactly. It's about improving the customer experience, making it easier to find the right product quickly, not just listing absolutely everything under the sun. Smart e-commerce, really.
Got it. Okay, let's tackle the big headwinds head-on now. Tariffs and LIFO. We know they're trying to use pricing to offset the tariff costs. They took action in May, then again in September.
Right. May was more focused on their direct imports. September started hitting products they buy from suppliers who themselves import. And they signaled more price increases are likely coming in Q4.
To cover costs they hadn't anticipated, like these Section 232 updates?
Yeah, exactly. It's an ongoing battle to keep up with the rising costs from various tariffs. They need to refine pricing further.
Okay, let's try to simplify this LIFO thing again. Why does last in, first out accounting cause such a headache when costs, like tariffs, are shooting up?
Right. Think about it simply. LIFO means you assume the last inventory you bought is the first one you sell. When costs are rising rapidly, like with tariffs, those last items you bought are the most expensive ones.
Okay.
So LIFO forces you to match your current sales revenue against those newest, highest costs first. This makes your cost of goods sold look higher, and therefore your gross profit look lower than it might under a different method like FIFO, first in, first out.
So it exaggerates the cost impact on the income statement during periods of high inflation.
Precisely. It creates what they call a LIFO expense. It's a non-cash charge that reduces reported profit now. It's an accounting method impact, largely.
And the hope is that this effect is temporary.
Yes. They expect this LIFO headwind to ease up by the middle of 2026, assuming cost inflation stabilizes. The long-term goal, once the tariff situation normalizes, is to get the total company gross profit percentage back to around that 39% level.
So given all that pressure, the tariffs, the LIFO impact, the mixed market, how did they adjust their outlook for the full year 2025?
They tightened the range. They didn't make huge cuts, but they narrowed the guidance. For sales, it's now $17.8 to $18.0 billion.
Okay, and for earnings?
Adjusted diluted EPS guidance is narrowed to $39 to $39.75 per share.
And what assumptions are baked into that?
Critically, it assumes the LIFO headwind continues in Q4, but they expect the price-cost gap to get better. It also includes the impact of those planned Q4 price hikes, and importantly, it assumes no new changes to tariff rates effective as of late October 2025.
Right. Always a risk there. Okay, stepping back from the quarter, let's think long-term. Does this quarter change their bigger strategic picture or their long-term goals?
Doesn't seem like it. They reaffirmed their long-term framework. They're still targeting double-digit adjusted EPS growth, compound annual growth rate, or CAGR. That's still the headline goal.
Double-digit EPS growth long-term. That's ambitious. What are the main levers they plan to pull to achieve that?
It rests on, well, three main pillars. First, keeping total company gross profit margins generally stable, aiming for that target around 39%.
Okay, hold margins steady.
Second, productivity. making sure their overhead costs, SP&A, grow slower than their sales, so getting more efficient as they grow.
Makes sense. And third, what about the growth from the segments themselves?
Right. They have specific targets there. For the core high-touch U.S. business, the goal is to consistently grow volume 4 to 5 percentage points faster than the overall market, year after year.
Taking share, basically.
Exactly. And for the Endless Assortment segment, the target is even bolder. Revenue, CAGR in the teens. That's a high bar for a business already getting quite large.
Driving huge growth there. And how are they funding all this? I saw a note about capital spending.
Yeah, they're investing heavily. Capital expenditures are expected to stay high, averaging around $600 million a year through 2028. A lot of that is going into their supply chain infrastructure.
Big investments. Where's the cash coming from?
Mostly from operations. They're targeting operating cash conversion, turning net profit into actual cash at around 100%. So they expect the business to generate the cash needed for these investments.
Okay, so wrapping this up. It feels like the core story of Q3 is this tension. Pretty strong growth, especially from the online endless assortment side, but that growth is bumping up against significant margin pressure from tariffs and LIFO, particularly in the traditional high-touch business.
That sums it up well. Solid performance, but definite headwinds making profitability tricky in the short term. Which leads us back to that segment mix issue we talked about earlier.
Right, the faster growth in the lower margin EA business.
Exactly. And here's something for you, the listener, to really watch going forward. If Endless Assortment does achieve that target of teens revenue growth, consistently outpacing the high-touch segment, what does that mean structurally?
It means the lower margin EA business becomes a bigger and bigger part of Grainger's total sales mix over time.
Precisely. And that creates a built-in natural downward pressure on the overall company gross profit margin percentage. It's simple math. So the really interesting strategic challenge for Grainger is, how do you fuel that high-speed growth in endless assortment while also trying to maintain that roughly 39% total company gross margin target they keep talking about?
It's like pushing the accelerator on one engine that naturally runs a bit less efficiently while trying to keep the whole machine's average efficiency stable.
That's a great way to put it. It's a strategic tightrope they have to walk. Balancing that rapid lower margin growth with overall profitability goals, that's the dynamic to monitor as they execute their strategy.
A fascinating point. That inherent friction between growth drivers and overall margin profile is key. Hopefully, this deep dive helps you see that complexity and understand the headlines better next time around. We'll catch you on the next deep dive.